welcome to the Everyday Real Estate Investor Podcast, where we talk to everyday people about real estate investing and how they're doing the thing and making things happen and how you can do the same thing. So today we have Jay Hinrichs here, investor, broker, developer, lender. You do all sorts of things. So
yes.
Glad to have you on the show. Excited to have you here. Appreciate you taking time to share from your vast experience.
Thank you, Ben. I appreciate being here and love to share what I know. I've learned over a 45-year career.
Yeah, it's a long time to learn stuff, and I'm sure you have some great gems for us, so we appreciate it. Yeah,
I'll try to impart those the best I can.
Awesome, thank you. Well, let's start out with I give a general idea of what you do. You do quite a few things. Tell us a little bit about what you've been involved in the past, what you're doing now, and just give us a kind of a picture of that.
Well, a little background is I started as a real estate agent specializing in land sales in Northern California way back in the late 70s, and I've done a lot of different things that you needed a real estate license for, which would be sales and development and ultimately hard money lending, which in California you can use a broker's license to lend. And I've also got a mortgage banker's license, which has allowed me to lend all throughout the country. And then some home building and developing and so on and so forth. So we've kind of worked through different decades, and I've kind of stayed in front of the market never stays the same. So when one thing gets a little hotter than the other, I kind of try to jump into that. And one thing you need to exit, then you exit that. So we're always evolving. We're always looking for the next wave.
Maneuvering. And we'll talk about the market too, because I want to get your take on that. But that's a really good, I don't want people to miss that. That is, the market's always moving. There's always opportunity, right? You just got to maybe make a shift from one thing to another as things are moving around in the market. So that's a key takeaway, I think, right there. So we'll talk more about the market here in a little bit, and I want to get your take on that.
Okay.
So how did you first get into real estate, and what drew you to it, and then what were your first experiences in real estate?
My dad got into real estate after trying many different things throughout his career, and he got into real estate late, but late to him was in the mid 60s, and he again got into land sales, which in California was a big business back in the 60s and early 70s. And if anybody's seen the movie Glengarry Glen Ross, that's exactly, he worked for Boise Cascade, which developed about 30 really large subdivisions in the Sierra Nevadas, mainly from San Diego to basically to Mount Shasta.
Okay.
And those developments would be 3,000 to 5,000 lots, and then you'd have a group of salesmen, and you would do in-home presentations, and then meet the people up at, they called it the track, and tour them and sell them, and it was quite something. And he did quite well at it, and then was able to go out on his own. Awesome. So I was basically raised in it, and I would drive with him, showing property, and so I learned how to read maps really early. I learned a lot of his sales techniques, which it's hard to learn from your father because, it's like, oh my God, don't do that, Dad. I got it. I can remember the first time he took me out to do an in-home presentation in San Francisco. We knocked on the door, we went in, we did one. I came out, I said, I got it, Dad, I don't need any more help.
Oh man, how old are you when you said that?
I was 18.
Okay, that's about right, yeah.
Just got my license. I got it, Dad. I'll do it from here.
Love it. That's funny. That's really cool though. I feel like, so my parents weren't involved. I kind of jumped in on my own, more or less. But that's kind of what I hope for my kids, right? Is to get them. My oldest is 15 and starting to ask more questions around that, and just being able to get them involved in the business. And they don't have to be full-time investors or whatever, but just the whole idea of building wealth through real estate. Maybe they want to be a doctor, they want to do something, but still being able to add that to what you're doing for your retirement and for building your wealth, right? And that's a lot of what we try to speak to here. Is like, you could be busy, like you're obviously full-time. I do a lot in real estate. But there's ways to be involved regardless, right? Yeah.
And the majority of what I've done personally has been transactional. I look back on things I could have, should have, would have, and held for a long time, which I never did, because I would have they'd go up in value, and like, okay, I'm going to take my chips off the table now.
Sure.
So some of that was really good timing. Some of it was not the best timing. But the majority of my personal career, because I'm in the business, owned real estate brokerages, owned a hard money lending company, has been transactional.
Yeah.
So the majority of the income comes from closing transactions.
Sure. Matching people up with other,
and taking fees and whatnot.
Yeah. And you're working mostly with investors in that sense, right?
A lot of investors, and then owner occupants. Like right now, our project we have in Canby is sold all to owner occupants.
Sure. Yeah. But you're on the development side of that, essentially. Yeah. So you're for sure. Okay. So talk a little bit. I know we're here in the Portland metro area. You've obviously mentioned a couple markets here that you're involved in, some of the sub-markets, but you work all over the country.
I do.
You're involved in a lot of different markets. You have a lot of experience doing deals across the country and partnering with other people across the country. So talk about what that looks like, and then I always talk about how it's great to look at deals in your own back door, but depending on what your goals are in investing, it may not be the best market for you, right? So just kind of opening up that thought process of, okay, maybe it makes more sense to go out of state and look at another market, but that can be intimidating for a lot of people, and there's a lot of pitfalls that you can run into. So talk a little bit about that and what to look for and what to be careful of and some of those things.
So for me, it started about 2002, 2003, when I was, I had started my hard money lending company here in Portland, and it was competitive to get loans, and I got introduced to somebody that was doing, they would acquire rental properties and then refinance them, and majority of this stuff was all led by California investors. Because in California, literally by the, 2000 or whatever, the price of a home got to the point in the Bay Area or the prime parts of LA, got very expensive, and you just simply couldn't buy them for rental purposes.
Yeah.
But people in California are very real estate centric. It's you go to parties and cocktail, a lot of talk about real estate, more than other parts of the country that I've worked in and been around. And so a couple guys in LA, guys and gals, decided that, hey, instead of $500,000 for a rental in Cerritos or $750,000 for a rental in Cupertino, let's go look at other parts of the country where the main thing is they could put 20% down, or do a rate and term refi and have zero money into the property, and they still cash flowed a couple hundred a month.
Yeah.
You could never do that basically on the West Coast.
Right.
And so these companies were marketing companies, real estate broker, lender, based in California, mainly LA, some in the Bay Area, but mainly LA, the big ones. And they align themselves with acquisition and rehab contractors in these markets. So I started in Detroit. This is my first loans that I did. So my position was the hard money lender. I would loan money to the investor in LA who would buy the asset in Detroit. They were already, remember, lending was different then. For me to lend them money, they had to already be pre-approved. And one of the guys in LA was a mortgage broker, get them pre-approved with Countrywide or Wells Fargo or somebody for the takeout. I would do the hard money loan and the rehab loan, and then they would have a 442 appraisal once it was done. So they were already pre-approved. So in 90 days, when we were done, the takeout loan would take us all out, and we'd all get paid.
Yeah.
And when we first started, they would get $5,000 to $10,000 per property back in excess proceeds. Because at that time you could still be all in on a property at 65% ARV of what it was going to appraise for in your new loan. So by the time you paid for closing costs and whatever, you still had about a 10%.
Making money to buy property.
Right. So they would get this overage back, and a lot of times I'd do 4 at a time for them, and so they might come out of that escrow with $20,000 or $30,000, which was supposed to go into their reserve account.
Yeah.
Something tells me it went to a jet ski, but I don't know. And then each house in those days, if it made $100 a month, that was they'd be making $400 a month, 20 grand in their pocket for reserves, and we literally did thousands of those for clients.
And this was back
pre-08.
Pre-08, okay, pre-financial crisis,
Right.
Yep.
So, and that was, if you read like Bigger Pockets or some of the other real estate forums, they've coined that as the BRRR, buy, rehab, rent, refi, repeat.
Yep.
Right.
Yep.
So I've done thousands of those for clients, literally. And so then '08 hit, and we all got our rear ends handed to us because you couldn't, the refi part of it
went away.
You could not get an investor loan. Didn't matter who you were. And so now I had close to 500 loans on the books, all scattered out in the Midwest and upper Midwest with no exits. And they're locked into my hard money loans, which are not intended to go long term.
Right.
So long story short, I worked out all but about 200 of them, and 200 of them I ended up owning.
Wow.
And so I ended up having to spend '09 the whole year out in the Midwest,
taking care of all that stuff,
liquidating,
control.
Totally. And we were not immune. I mean, we lost millions in that venture because we were using bank lines of credit to fund this stuff.
Which they probably called due, right?
They called due. We had to mark to market the assets. They were dropping like rocks, and it was
challenging times.
It's the whole reason I'm sitting here, because if that event had never happened, I'd been long retired. I was ready to hang it up right then. I had built this up over 30 years.
And then you lose it.
And then we had to, and it didn't matter if you had rental property or cash flow or whatever, when in those areas and parts of the country just got hammered. So I didn't have anything in Phoenix or Vegas, which really took it. But I had a lot of stuff in Atlanta, and Atlanta had some major problems.
Okay. So I'm going to come back to a piece of that here, but I think this is a perfect time to just kind of pivot to what's the market doing right now? Because I think so many people got hurt in that time during the financial crisis. We have PTSD from the crisis that happened there, and people lost money and jobs and all that. So people think that that happened then, so that's what's going to happen now, right? That's because that's what they saw. So they're like, okay, here we go again, back to 2008. We're going to see it again. So what do you think? And you've got opinions all over board. If you look online, you got some people saying the market's going to keep going up. You got some people saying the market's going to crash. What's in your humble opinion? Where are we at, and where are we headed?
I thought we were going to pivot about 2018, and I missed that one.
Right. Yeah.
So I think we're pivoting now.
Okay.
We're finally pivoting now, and because the rates have gone up. As long as the only thing that would create a replay of that would be a freezing of credit altogether. As long as credit is still going, it's just going to be a price fluctuation to keep investors in play. And one thing we have to remember, especially in the Midwest and here, rents have gone way up. They're full, and that is the people that bought with the low interest rates 3 or 4 years ago, they are super strong right now. I mean, really strong. And the people buying today can still get the same metrics because the $1,200 rental, in Baltimore, HUD, I was just in Baltimore 2 weeks ago, HUD Section 8 is now $1,600. They came out with all new pricing. And that's still, we can still back in to all these, and they still cash flow. And a lot of the people that are doing the refi are still basically getting all their money back, and maybe not pulling out cash because the banks don't want them to, but they're cash flowing, and they look strong. So I think consumer sentiment is what's going to drive a lot of this. The negative stuff that you hear about, it's all crashing, that you see on YouTube and whatnot, it's all the same guys with the same predictions. That will scare people to not taking action. There's no question. But it's hard to think of someone who locked into a 3.5% owner-occ loan or a under 5% investor loan and everything's going well. Where is the crisis?
Right.
Unless they have to move, and then they have to mark to market. But if they don't have to move, or their investments are going okay, you're not going to get this crash.
Yeah.
And all the loans that are out there were completely written differently than the pre-08.
Yeah.
I mean, I remember looking at some of those files and like, oh my God. I was in Detroit and at a couple closings. I just watching this, and out there they do the old school. Everybody gets in the same room, and I'm watching this kid buy this house from me, and he was like 22 or so, and looking at the paperwork, and I go, and he's getting like $18,000 back out of this loan, and I'm like, that'll be a first payment default. He's going to take that money and go spend it. I saw that part of it coming. But I just don't see the, I think the day of, okay, you don't want to be investing because it's $500,000 today and next year it's $600,000. I'm going to make $100,000.
Yeah, the speculation.
Yeah, there's no speculation to be had right now, unless you're buying way under market today.
Yeah, value add.
Or you're doing value add. So that's how you're going to create equity.
Yep.
Your appreciation now, I think, is kind of sad.
It's not going to be 30% annual appreciation like it was last year.
And like with the builders, like with us building our project, we're building 90 houses in Canby. I mean, we had to raise our prices because the cost to build the house went up $100,000.
Yeah.
Same house. 2 years later, it's $100,000 more. So you just add that on, and that's a lot of why the new construction is priced where it is. Yeah. It's not profiteering. It's not that it went up that much. It's because the cost to build it went up that much. Yeah. And of course, in Oregon, we're also the small builder like me, a little guy that nobody knows about. I still have to compete against Lennar and Horton and some of the other guys, David Weekley and these other companies that have come out of Texas, and they're strong competition. Yeah. So it's hard for us to get a project here.
Yeah, yeah. Well, I think on the market piece, you hit on a lot of stuff it's great to get another take that's similar to what I put out there, just to kind of confirm, hopefully, to people listening that I'm not the only one that thinks this way. And that, because it's like, so number one, the negative stuff, unfortunately, it can become a self-fulfilling prophecy,
no
right?
question.
If people listen to it, right?
Consumer sentiment is the number one driver of this whole thing.
Like, we're crashing. If everybody thinks we're crashing, so they hold back, then we're going to crash.
Yeah, the money doesn't cycle.
Exactly, yeah. But you hit on a couple, and so it's the same thing can be said about lending, right? So you touched on a big part of the issue in the financial crisis was lenders just stopped lending. So there's no liquidity. Right. So that just perpetuated the problem, because it's like, now you can't refinance out. Now you can't, buyers couldn't buy. Like, there was no purchasability. So it was, prices had to keep coming down because there was nothing to buy with.
It was a perfect storm. And I like to say, just think of the auto industry, how many, $90,000 Escalades would sell if they had to all sell for cash.
Right.
That's where we were from 08 to 2010. Yeah. Real estate sold for cash, and only cash buyers were buying. Lots of foreigners came in, lots of Aussies came in, and houses that should have sold for one back east. I mean, I had one in Georgia that appraised for $140. I did a $90,000 hard money loan, and by 2010, the highest offer I got it on for cash was $40,000. Wow. And I had to sell it. Yeah. And today it's right back to 200,000. Yeah. So there was a timing in there. Now today, credit has not frozen, and people are not going to, there's going to be a point where it'll come down, and some people will be forced to sell, but most people that aren't forced to sell or just won't sell. That's going to create a shortage of inventory again. It's going to be a cycle.
Which is really another interesting thing, because I think builders are paying more attention now. I think there's a lot, and now people, it's interesting because people weren't putting their house on the market for a while because they couldn't find something on the other end. Well, now people aren't putting it on the market because They're afraid of I mean, there's like always reasons to not put your home on the market, and all of it is continuing to constrict supply, right?
Absolutely.
So I think that's like we were way oversupplied in the financial crisis. We had no lending to speak of to buy. We're just in a totally different spot. Not that something can't happen, and not that there can't be a pullback, and not, and every market reacts a little differently because inventory levels and all sorts of drivers and everything. But as a whole, people have equity, loans are different.
Yep.
Builders are more cautious.
Well, especially the people
that have a lot of things that
have these 2.78 to 3.5, where rents are, and rents usually don't crash.
Yeah.
Their monthly payments are equal or less than rent.
Yeah.
I mean.
Yeah, and that's another key piece. And rents keep going up. So they're gonna, even though rates are higher, at some point that still has now it makes sense to buy again, right? So.
Mm-hmm. And then time cures. No one can time the bottom. So people that are sitting on the sidelines waiting for this crash to come, and I'm going to wait, and if it doesn't come, they've missed out, and people are still buying. Time solves a lot of real estate over time. Time heals real estate.
They say real estate, the price of real estate doesn't matter unless you're buying or selling, right? So if you're doing something in between, if you're holding it, of course we all want to buy it for as little as we can, but to try to time the market is just you're not going to do it.
And you need to, the only other caveat to that is small town that has a single employer and they move, and that's saying all the jobs go away.
Yeah.
But those are very isolated instances. So basically on the West Coast and in the bigger markets we work, those are still stable. I go out to Baltimore, and a ton of the people are working for the government, Washington D.C. and
those jobs aren't going away, are they?
And all these cities have their core employment and their growth factors going on. So it just I think the day of I bought this for $5 and it's worth $650 a year later. I think that's come to a whatever you're paying for them now. That's going to be your price, and it'll take the next big run up to get a lot of appreciation on top
so
of that.
Thinking a little bit longer term, or creating value somehow through development.
Right. For investors, it's creating value.
Yep.
Mm-hmm.
So going back to the out-of-state market aspect, so is there something like in particular that you're looking at in your markets or to get involved there?
If your audience is local here, and obviously I do couple hundred transactions a year out of state for my teams in place, and I would say 125 of those or so are sold to investors, and what quote unquote turnkey model. And the key to that, if someone is going out of state, is you don't want to chase. You don't want to sit there and look at property based on pro forma returns and just generate right down to, that one's a 12% return, or that's a 10 cap, or that's a blah, blah, blah. The Midwest, over everything, prices for risk. And you can go in, and buy, still today, all in $30,000, $40,000, $50,000 houses in these communities that on paper will show these astronomical returns, but they're also, you're renting to the most unstable tenant base in the United States. So you may get rent for 4 months, and then they stop, and then and then you have to kick them. And the net effect is you lose money. On paper, it's like if they pay rent and you don't have any problems and all that, you get a 20% return. But the reality of that is, it's not going to happen. Right? It's got to be your passion and your job. The people, my clients out there that own rentals, own 100 in a city. My Baltimore guys have 140 of them. Mm-hmm. They're there every day. I ride around with, it's 2 guys. They're on the road at 9 o'clock in the morning till 6 o'clock at night, and probably 8 o'clock every day, driving to all their properties. It's a real hands-on approach. So for the West Coast investor that wants to buy and hold long term, it's still extremely viable, but you want to just use basically common sense. Check out the school systems. You know, don't be buying in like Atlanta, Gwinnett County. Their school system's one of the worst in the country. So you don't want to buy there. You want to go to the next county down, Henry County, which has a really good school system, right? So you want to look at that. Section 8, like a Baltimore, Section 8 will mitigate a lot of the school type things. But if you go to, like we were talking about, Indianapolis is a perfect market to look at schools, average price points. So if your average price point in Indy, let's say Metro, is 180, which is probably 160 to 180 now, believe it or not, maybe 200.
Yeah, if you live out here in Portland Metro, you're like, what? For the lot, right?
No, this is the median for the house.
Yeah.
You don't buy a $60,000 house because it looks great. You buy as close, if you go to any of these cities and you buy as close to the median and it still fits your investing criteria, and maybe you have to put 30% down instead of 20, you're going to have a solid rental. I don't care what part of the country you're in. You just have to get to into neighborhoods where homeowners are buying the houses and some investors. If you go into the lower end, the 50, 60, 70,000 in this case, or anything under 100 basically, you have to be very choosy of what you pick, but the majority of those neighborhoods are going to be 100% rentals, and there's just going to be a ton of turnover.
Yeah, that's a great way to look. So median, whatever the median is for the area, by kind of in that
within
20% or something.
10 or 20% up or down of that.
Yeah, okay.
And the other thing that's critical, if it's a house, it's a single family home, I used to say $1,000 a month. I like to now say $1,200 a month for rent, because that's the other thing where investors will look at, okay, I can get the $60,000 house and the rent is, the 1% rule, it's $600 a month or $650. You don't have enough gross income to take care of your capex going forward.
Right. Yeah.
Because the roof when you have to replace the roof or any other capex item on your $60,000 house costs the same as a $200,000 house.
Yep.
But the $200,000 house, let's say, is renting for $1,600.
Yeah.
And now you have a lot more gross income to build your reserves out of. Where your $600 rental, you're on a very thin margin.
Yeah, you're making a little, but not enough to pay for those capital expenditures when they come up. Yeah.
And then of course property management is the key to all
your
of
team.
it.
Yeah.
You got to have good property management, and you got to be on top of them.
Yeah.
Like I said, at one time I had about 300 of those houses.
Yeah.
And it was a chore to stay on top of it.
Yeah. And we were talking before about some of my initial out-of-state experiences, and that was really where we failed as investors. It's it's easy to blame the team, but ultimately it comes back to you as the investor running the investment. And we picked the wrong team, and it's important in your local market, but it's especially important. They're your eyes and ears, and they're the ones that are there on a day-to-day basis, not you. So that you're really relying on them even more when it's
the other point I'd really like to make also with buying as good as you can afford when you go back east is think about all the property managers vet people the same way. You have to have 3 times the rent to qualify.
Right.
3 times the rent on a $600 rental is $1,800 a month. You take $600 for rent, $200 for utilities, cell phone, whatever, and the next thing you know, they're living on $800 a month.
Yeah.
Ask yourself, how would I do with $200 a week to live, pay for gas, pay for insurance, pay for clothes, pay for food?
Yeah, which is all more expensive now.
Right. and if you really look at it,
how can they? You're increasing your odds of them.
We can't conceptualize that as investors who can afford to go and pay $60,000 cash for a house.
Right.
We never look at what is our living cost.
What is the tenant base?
Yeah, this is just something.
Yeah,
we're living.
absolutely.
But if you go into those same markets and you buy a $1,200 or $1,500 rental, the next thing you know, your $1,500 renter to get in has to be making $4,500 a month, and
big difference.
And now they have $3,000 of discretionary income. Yeah. They're living in the same market. They're buying the same gas and everything, so they have a better chance of making it.
They have a lot more disposable income. Yeah,
exactly.
Yeah.
So
yeah, very good point.
That's a key point.
Yeah, very very true. Awesome. Those are some good tips on looking at a state for sure. Yep. So team, buying at the median price point.
Best buy, and the median price point is going to put you in some owner occ, so you will get some appreciation.
Yeah.
When you buy way below, I mean, just think about, you just have to use logic. If it's the cheapest house, there's a reason it's the cheapest house.
Yeah. And that's what I was going to say. It's really easy, especially as a beginning investor, to look at, oh my gosh, and especially if you're in an expensive market.
Right.
I can buy a house for $30,000
right.
and rent it out. I'm all over that, right? Hold on, time out.
Right. Now the caveat,
right? Just because something's cheap is not because it does not mean it's a good deal, right?
The caveat on the renter though is multifamily. Now a lot of the multifamily is still $600 to $800 a door. So I'm talking about single family homes, the type of tenant you get in there, and you as an owner. Multifamily is a different way to manage it.
Yeah.
And you just look at cap rates and back it out. I'm talking about single family homes.
Yeah. Yep. Makes sense. Awesome. Well, if you're willing to humbly share, you did share a little bit about your experience in the financial crisis. Talk about a mistake that you made in your 45 years of experience that our listeners can learn from and maybe not make the same mistake.
Well, I've made it hasn't been all wine and roses, that's for sure.
Hey, if you're not making mistakes, you're not in the game, right? So
the biggest woulda, shoulda, coulda, and this is for the local investors here. For me, was I had a couple properties in Palo Alto, California that I bought in the early '80s for under $200,000 each. That then by 1990 got to $500,000, and it's like they could never go any higher, and I sold them, and worrying about negative cash flow, because even at that day, if I rented them out, I would have been like $250 a month negative on them.
Mm-hmm.
Like,
and
man.
You could stomach that,
yeah,
right?
Absolutely couldn't
I get
do
that. Yeah.
As it turned out, if I still held them today, the rents quickly went to positive. They would have been positive by thousands a month, and the house I paid $200,000 for is now worth $3 million. I mean, I've seen it on sold
that hurts.
on Zillow, and I had two of those.
Yeah.
And so the woulda, coulda, shoulda was ever selling anything I bought in the '80s in the San Francisco Peninsula.
Yeah.
And you can say the same thing with Portland.
I would think that's a good assessment. Yeah, it's a good parallel. Yeah.
But you can't go back, and the $300,000 I made in the late '80s on those, springboarded me to
easy to make decisions in hindsight, right?
Yeah. Yep. And then I'd say just generally, when deals are going, and I'm guilty of this to this day, when deals are not going right, just realizing that and cutting your losses right then and getting out of it. I've many times tried to hold on, help my buyers, help my borrowers. They don't really appreciate it, and it just gets worse and worse and worse. And you as the investor or lender just get in a worse situation.
That's an interest. Yeah, because it's like as a lender, here's the terms. If you don't follow the terms, sorry. As a person, it's like, well, let's see if we can work through that. But sometimes, I think there's probably a balance to that. But
there is, and for landlords for sure.
Yeah.
I'm $500 short. I mean, I am the worst landlord because I'm too busy to really worry about $200 or $300 if they didn't pay me, right? And I don't want a victim over all of that.
Yeah.
And but I did finally hand over all my collections to somebody in my office with, here's how you're going to deal with that. And once they stopped calling me, our collections went way up.
Yeah.
Because Dory was like,
take care of it. Yeah.
She was on them, and she was a single mother. She didn't really care what their excuses were.
Yeah, because she's had them all too.
Right.
Yeah.
Right.
Yeah.
So
So empathy, but not necessarily
Yeah.
Like, but you still got to pay up, right? Yeah, yeah. That's great. Yeah, yeah. So cutting your losses and not, continuing and maybe hold some property.
Yep.
In the right areas. Yeah.
Yeah. If you're in a prime area, and I consider the Portland Metro to be a prime area, holding through, any kind of downturn and instead of just panic selling, would be what I would advise.
Awesome. Okay.
Yep.
Great advice. Well, I appreciate you being here and sharing all this knowledge. I think anybody listening to this is going to learn a ton. So we appreciate that a lot. I know you're on Bigger Pockets forum a lot, so people can connect with you there. Is that the best way for people to reach out to you, or what's the best way?
If folks are looking to invest out of state, I'm pretty passionate about that. So they could email me about that, and the markets that I know, I can at least direct them to a team I know that will help them.
Yeah.
Because you have to be really careful with the teams out there. Not all of them are ready for prime time, and you don't really know if they've been in the business for very long, or if they're good people.
Yeah.
Because when I first came to Oregon, I still remember, we'll just list that, and someone from California will come up and pay double for it. Right? That theoretical thing where Californians were stupid and they would overpay for Oregon real estate.
Right.
Well, believe me, when you come from Oregon, you're a West Coast investor and you got some money and you're going to the Midwest, that's exactly how those people feel about you.
Yeah.
They don't really know, they're going to overpay, so you need to be able to...
Those are probably not the providers you want to be working with, the ones that have those.
Right. Yeah, they have that.
But you don't know unless you start working with them. So referral is a great way to start. So that's,
Exactly.
Great. Okay, so Bigger Pockets is probably the best way for people to connect with you, or email, or...
I don't own Bigger Pockets because there's so many people there, I would be inundated.
Inundated, so
you can give them my email, which is, they can do info@JLH Capital Partners.
Perfect.
That'll go into my company website.
Awesome.
And then I can get that.
Very good.
And just say, hey, I listened to your podcast and I'm interested in this.
Out of state or whatever.
Right.
Yeah.
Right.
Awesome. Well, appreciate you being willing to do that, and appreciate you being here and chatting. And again, I think people learned a lot, hopefully, and a little bit more maybe not sure is not the right word, but the market, kind of just some insights on where the market's probably going, and don't sit back on the sidelines, right? Keep doing the thing. There's always opportunity to look for.
If a deal is a deal, and the interest rates are here to stay for a while, basically get your foot in the door, continue to grow your portfolio. They come back down again, you can do the refinance, but to do nothing, you don't get anywhere if you do nothing.
Exactly. Yep. Take action. Awesome.
Right.
Very good.
Thank
Good
you,
last
sir.
advice. Thanks, Jay.
Appreciate it.